Welcome back, everyone. Today on the Joseph Carlson Show, we're getting close to the end of the year. We're now in October, and I think it's good to look back and see how things are going. We're going to be taking a look at the Story Fund. This is, of course, one of my main portfolios. The Story Fund is worth nearly $240,000. This is all money that I've put in over the past few years, and $74,000 of that is now gains. So it's doing well, making some gains. It's currently in 5 different companies. But today we're going to see how it's really doing. We'll be looking at the Story Fund's performance year to date, how each company's doing, and how the portfolio is doing overall. We're also going to be looking at how the Story Fund's doing compared against the S&P 500 since inception. So we'll get a full accounting of how this one's doing and if it's achieving its goal of beating the S&P 500. Now, of course, we also want to look at how the general market's doing. We know that the S&P 500 and the QQQ are both up a decent amount this year, around 20%. But there's some companies doing better than others. Today, we're going to take a look at the 5 best stocks in 2024 and the 5 worst stocks in 2024. We'll go through each of them and see why they did so well or why they did so poorly. Now, of course, we also have some other news to get to. The jobs report came out. It was much better than expected. We'll be taking a look at what this means for your portfolios. We also have news that the port strike is already over. That was fast. We'll see what happened with that, what the response was, and some criticisms I got from the previous episode I'll be addressing in this one. And then finally, we have an update on Mr. Beast's $100 million reality TV show that he is premiering on Amazon. We'll be taking a look at how that's going and what I expect it will do for Amazon. So we have a lot to get to in this episode. Let's go ahead and jump in. Now let's go ahead and start off. We'll begin by looking at my portfolio. Now you may be unfamiliar with this if you're one of the new members to the channel. We've had a lot of new people, new viewers show up. But I don't just talk about finances. I don't just talk about financial content. I also invest. And I do it transparently. You're able to see my investments, what I'm doing with my portfolio, how I'm trying to compound wealth as fast as possible. And I'm completely transparent in doing this. All of this money is money that I've contributed. It's all stocks that I've bought. All of it's real. So this is all live, and you're going to see updates every single week with these portfolios. The Story Fund is one of my 2 portfolios. This one's a little bit smaller, but it's still a very meaningful amount of money. We have $238,000 of total value. $74,000 of that is gains. Now, in this portfolio, we have Amazon as the current largest holding by just a hair. Amazon is currently 32% of the portfolio. Netflix is 31%. So out of this pie here, this portion right here is Amazon. This portion right here is Netflix. Over 60% of the portfolio, around 63%, is Amazon and Netflix. So it's highly concentrated into these 2 companies. Why do I have so much concentration into these 2 companies? Because my level of conviction meets with that concentration. I am highly convinced, whether right or wrong, I am highly convinced that these 2 companies are both going to be very prosperous in the future. Now, they are already successful companies, but I think that Wall Street, I think that investors are still underestimating the extent of which these companies will be profitable and be successful in the future. And I think the chances of me being wrong on them, although it's not 0, I think it's very low. The chances of Netflix or Amazon both being a flop, I think is highly unlikely. So these ones I've made rather large positions in the portfolio. The other ones are a little bit more standard. We have Google here. This one is also very concentrated, 18% position. We have S&P Global and we have Microsoft. Again, highly concentrated positions, but not quite as big as Amazon and Netflix. Now let's go ahead and quickly break down these companies' performance year to date. We can start off with the biggest one, which is Amazon. If we look at Amazon year to date, we can see it's up 23.4%. Now that's good, but it's not amazing. The S&P 500 is up 20%. So Amazon is really doing okay. It's adding to the portfolio. I guess it's adding a slight amount of alpha. If we look past the full year, it's beat out the S&P 500 by a good amount. But in 2024, Amazon is barely beating SPY. So it's good, but not great. I'd love for this one to do better. I still think that Amazon is undervalued. I still like having it as a large concentrated position because Amazon is in the process of rapidly growing free cash flows. We see that leverage, that operating leverage in the business model playing out. It's a striking amount of free cash flow growth over the past year. They do have some issues they're facing with employee compensation, with all different challenges Amazon faces, but I really think this one's going to overcome them. Now, we have Netflix here. This is number 2. If we look at Netflix's performance year to date, this one has been great. This is one that I'm glad I sold Apple in the story fund to buy Netflix this year. That trade worked out really well. Netflix year to date is up 53%. It's just killing it. Netflix is doing so well, and they deserve it. If we look at the performance, this is not a company that's just going up in stock price while the fundamentals remain the same. Netflix's total subscriber count has exploded in 2024, continues to gain millions of new net subscribers every single quarter, every single month. The revenue has accelerated over the past couple of quarters. Netflix in the most recent quarter grew revenue by 16% on a constant currency basis, meaning if you adjust for currency fluctuations, they grew revenue by 18%. Netflix is growing faster than the majority of big tech, and they have operating leverage on top of that. So between those two things, I'm not surprised to see Netflix gaining as much as it has. The stock is currently at all-time highs, pushing higher and higher. So again, I'm very excited about how Netflix is doing. So we have Amazon up around 24%, Netflix up around 53%. Then we move on to Google. But it's not done too well this year. It's basically just in line with the S&P 500. Now, this is because of a lot of narratives around Google. They are facing narratives that they're getting beat in search by different search competitors. They have OpenAI on their tail with artificial intelligence. But overall, I think a lot of those concerns are oversold. I think Google's doing fine. I think the company's going to be fine in the long term. We look at what they're doing, and I actually think they're doing a great job with Gemini, their artificial intelligence LLM. I think they're doing a great job with YouTube. I think they're doing a great job even with search. So I like to see what they're doing. Right now, the stock is trading at a 3% free cash flow yield and a lower forward PE ratio than the S&P 500. So the fact that it's at a cheaper price than the S&P 500, I think sets Google up to continue to be a good investment right now. After Google, we have S&P Global, which is a 9% position. It's up 17.17% year to date, so it's just below the S&P 500. Right now, it's not adding to the outperformance, but it's also not taking away too much. And in the most recent months, it's really had a surge. I think the S&P Global is going to be just fine. As they get through this merger, this acquisition they did, they continue to grow like they have. And the segment of business, which is the ratings, continues to go up as the debt market recovers. This company is going to make more and more money, and I think it's going to do it with a great degree of predictability. So I like how S&P Global stands right now. I think it's a fine company to have in the portfolio. I also think the company's undervalued. Finally, we have Microsoft at an 8.8% position. Microsoft's one of the ones that I'm not sure how undervalued it is. To me, it strikes me as a company now that's at a full valuation, or at least somewhat fairly valued. But it's still such a great asset that I have a difficult time selling it. I don't like selling the second in command of hyperscalers, the second cloud leader. Right behind AWS, we have Azure. And it's really difficult for me to take gains in a company like that and walk away from it. Now, it's only up 13%. So again, along with S&P Global, this one is actually hurting the performance year to date. But I don't consider it too much of a problem. Last year, it dramatically outperformed. So we have a little bit of ebb and flow. And even though it's not doing the best right now compared to the S&P 500, I think that the S&P 500 is being held up by a lot of companies that can't sustain their free cash flow as well as Microsoft. So I'm still happy to have this one in the portfolio. So the S&P 500 has returned around 21%. The Story Fund has done around 27% this year. Now to look at it since inception, I also have a chart that I keep updated. I just updated it as of this morning, and this is what it looks like. The Story Fund is in blue. The S&P 500 is in red. The S&P 500 currently has an all-time return of 44.38% based on when I started this portfolio. And the Story Fund has a current return of 52.72%. So it's beating the S&P 500 by around 8 or 9%, which is okay, but it's not as much as I'd like. I'd like for this to have a bigger gap between the two, and I think I can do that over time. I really like the way this portfolio is positioned. I think over the upcoming year or two, it's going to do really well. And if you want to follow along with this, I'm going to be tracking my portfolio against the S&P 500 at least until the end of next year, till the end of 2025. That's when we'll see if I can close out a victory or if the S&P 500 pulls ahead. So that's an update for my portfolio. I'll continue to do those. I want to change gears and look at how the overall market's doing and what companies are doing really well, which ones are struggling. If we look at the top 5 best performing companies and the top 5 worst performing companies of 2024, you may notice some trends. Now, to make this a little bit more interesting, I had to omit energy companies because energy is in a cyclical swing right now. Energy companies are going up and up and up, and they basically all fill up the top 5. So I filtered out the highly cyclical oil companies so we didn't have to discuss those. Now, in number 5, the top 5 performing company in 2024 is Fair Isaac. This one came in 5th place, and it's had an incredible year. Currently, it's up 69% year to date. So Fair Isaac is one that I've talked about a lot. They have the FICO score. It's an incredible company. The big thing causing this stock to go up is their pricing power. They have massive scale and they have unmitigated pricing power. It has not been challenged that much by Congress, so they're pulling that lever. They're raising prices and they're able to get away with it. But I would be really surprised, given the circumstances with their elevated debt and already pushing through a lot of price increases, if they're able to keep up this rate of growth. Maybe they can, but I personally don't think they're going to be able to. So FICO is number 5. Now we move on to number 4, which is Meta. Meta has just been on fire for the past couple of years. The stock has been great for the past couple of years. Even year to date, it's up 69.53%, barely beating out FICO. Mark Zuckerberg is on fire. Everything he's been doing is great. And if I had bought into Meta somewhere at the lows and I was heavily in the green, even at the valuation it's at right now, I would still be holding the company. If I had bought in a while ago, if I was in the green by a large amount, I don't blame anyone for continuing to hold this company. I still don't think it's at a crazy valuation at this point. So Meta has a well-deserved 4th position as the best performing stock in the S&P 500 this year. Now in number 3, we have a company that I don't recognize. It's Howmet Aerospace. This one has gone up 89% year to date. When I look at what this one does, we can look at a brief investment description of the company. They provide advanced engineering solutions for the aerospace and transportation industries all across the world. They name off all of these countries. The revenue is a little wonky on this one. They may have had some acquisitions and divestitures. They may have had some things that they sold off in the company because the revenue doesn't make sense otherwise. And this certainly doesn't strike me as a compounding machine. And the further back we look at the financials, the more clear the picture is that this is a highly cyclical company in a highly cyclical industry. So we have some serious zigs and zags in their profitability. Either way, Howmet Energy is number 3. Moving on to number 2, we have a familiar name here, Palantir. Palantir has done so well this year. It's actually incredible. The stock is now an $84 billion market cap company. Every time I open up Palantir and I check the stock, it's up another 3%, another 2%. Just today, the market's up 0.7%. Palantir's up 0.45%. It had actually touched $40 per share. So again, it's just done incredible. It's up 142% year to date. Now, in my most recent video, I mentioned that Palantir is an expensive stock. I know that's a bit controversial to say this company is just a tiny bit expensive, but if we look at the valuation metrics, I think there's reason to believe it's a little expensive. It does trade at a 93 forward PE ratio, a 33 price to sales, a free cash flow yield when you adjust for stock-based comp, that's 0.2%. So I'm sorry, I didn't want to poke the bear or make anyone upset, but I think the stock is slightly expensive. And I also mention every single time, I don't think that necessarily means it's overvalued. There are plenty of examples of cheap companies that appear cheap that end up being overvalued in the long term. I've been looking at those companies before, ones like Paramount Global. That was a cheap company that was overvalued. But there's also examples of expensive looking companies, ones like Palantir, that end up being undervalued. Maybe this could be another one. So as I follow this company, I think it's interesting to see. It's been incredible, the performance of it. It does trade at some really high multiples, but it still could do well in the long term. So Palantir is number 2 and the best performing this year. And number 1, you may have guessed it, the best performing stock this year is of course NVIDIA, now a $3 trillion company. Now year to date, it's up 158%. June was where NVIDIA got to $135 this year. Since then, it's struggling to keep up to that price. It continues to ebb and flow, mostly below the 135 price point. So it really has performed really well until June, and then it's taken a bit of a breather. It makes sense for NVIDIA to be the top performing stock in the market this year. When you have revenue growth that looks like this, where it's so explosive, it's hard to top that. But NVIDIA is at a point where it's now becoming increasingly difficult They have the big blowout quarters like they did previously. The stock is already priced for those blowout quarters. So they need to have blowout quarters that are even bigger than expected, even bigger than what the analysts are expected. And this is the problem with expectations. The expectations for NVIDIA are so great that it's becoming super hard for NVIDIA to beat those high expectations. Maybe they can do it, but they're going to have to continue to grow at an incredible rate. So there we have the top 5 performing stocks of 2024. Now we venture into the worst 5. Now starting off with the 5th worst performing holding in the S&P 500 in 2024, we have Warner Brothers Discovery. It's a little surprising because this company seems like a decent company. They have the Max streaming service. They have the Penguin. It's a great start off to a new show. But the stock is down 34%. And that's because investors are further realizing the reality of the situation. The reality of the situation is Netflix has won. Newsflash, if you haven't got the memo yet, Netflix won the streaming wars. Although this company can generate some free cash flow with their movies, they are struggling to keep subscribers. They're struggling to grow internationally. They're struggling to have a great ad program like Amazon Prime does. So the stock is generating some free cash flow, but the earnings are negative because they're paying down enormous amounts of debt. And they'll continue to have to pay down a lot of debt for years and years and years to get to a better situation. They still currently have $37 billion of debt. This company has some good content, but unfortunately, having a few good shows is not what makes a great streaming service. What makes a great streaming service is having a fire hose of content where you can continually, every single week, put something new on for a variety of different audiences, not just for some niche viewer. So even though Warner Brothers Discovery has some good shows, I'll admit it, the stock right now is struggling, and in this situation, I wouldn't be buying in. So Warner Brothers Discovery is the 5th worst performing. If we go to number 4, that is the Boeing Company. This one has been a disaster for years. This is a company that when I was first investing, if we go way back until 2017 and 2018, I was just a green investor. I was making my portfolio, and Boeing was one of those nice, steady dividend payer companies that I added to the portfolio. Later, I realized that this company was complex, disorganized. It didn't have great leadership. It had a lot of qualities I didn't like, so I sold it. This one is one that I continue to believe is just not a good investment. I think if you talk about Boeing being a duopoly and being a great investment, I don't think you're looking at the complexities of running this company and what they deal with. It is very difficult. It's currently down 39% year to date. So the Boeing Company is the 4th worst performing in the S&P 500. If we move on to the 3rd worst performing in the S&P 500, we have Lululemon. This one was really well liked by the compounder crowd over the past couple of years. But when you go into fashion, when you go into apparel, you're venturing into territory where there's not a great deal of predictability. Even the most predictable companies in this industry, Nike being number 1, had an incredibly difficult time over the past couple of years. And Lululemon was another company where people talked about it like it could never miss. They could never lose. We look at the performance year to date, and it's down 46%. So the stock price is nearly chopped in half starting in 2024. Investors blamed it on the valuation. They said it was a 34 PE ratio. But I think there's another challenge for Lululemon, and I think that is competition. There are so many newer competitive companies like Vuori that are taking market share from Lululemon. And I think this one's going to take a while to recover. So Lululemon is number 3 worst performing holding in the S&P 500. If we move on to number 2, we have a bit of a surprising one here. It's Dollar Tree. This is one that I have not paid attention to at all. I know the business model a little from Dollar Tree, but not much more than that. The company's super inexpensive. It's at an 11 forward PE ratio. It's at a 3% free cash flow yield. It seems cheap, but this is a company that I believe is cheap and overvalued. It's one that I think will cause investors more and more trouble as they spend more time on these lower quality companies. It's currently down 50% year to date. Frankly, I don't know a lot about this company. It's not one that interests me. There's so many different characteristics and qualities that rule this out as a potential investment that I'd never spend a lot of time researching this one. So Dollar Tree is the 2nd worst performing in the S&P 500 in 2024. If we move on to the worst performing stock this year, it's Intel. Intel has been such a sad story because unlike Dollar Tree, I have seen a lot of individual retail investors go into this company. Many of them buying it because they believe they're buying a quality company, a long-term dividend payer, one that used to have a dominant moat, but Intel has become weaker and weaker in its market position over the past decade. And the CEO, Pat Gelsinger, buying the stock hand over fist over and over again is not enough to convince me to buy this stock. It doesn't matter how many insider buys there are, I'm not touching this one. So there we have the 5 best performing and worst performing positions in the S&P 500 in 2024. Maybe we'll do another update at the end of the year and see how things turn out. Now, moving on, we get to the news here. The big news of the day causing the markets to surge, which is the jobs report, blew past expectations. The Wall Street Journal notes that hiring accelerated in September, blowing past expectations. They say that the 254,000 jobs added in September was significantly more than the 150,000 economists expected. So they outperformed, or the economy outperformed the expectations by 100,000 additional jobs. We expected 150,000 and we got 254,000. The consequence of this, as the Wall Street Journal notes, is that this basically takes off the table the chance of the Federal Reserve to do another 50 basis point rate cut. There is some speculation that the Fed would cut by another half point or 50 basis points. They're not doing that. Now, in my opinion, that's a non-issue because I thought there was very little chance they'd do another 50 basis point cut anyway. I just didn't see that happening. I think they're going to start off with the 50 basis point, then they're going to move to a 25 and do a 25 and 25. So this is something where, of course, they're not doing that for sure now, but I don't think they're going to do it anyway. Now, looking at this through an investing lens and how this type of news impacts your portfolio, the way that I look at this type of economic news, when we have jobs reports that are doing well, when the economy is growing, it's a simple truth. Typically, when the economy does well, when things are good for the economy, when they're good for jobs, when they're good for workers, it's good for the stock market. That's the simple truth. People might argue differently because of impacts of interest rates and how it affects the Fed, but I don't think that should be the takeaway. Over time, most things that are good for the economy are good for the stock market. The stock market, in part, is a reflection of the economy. Companies do better when there's a strong economy, when people are happy, when they're working, when they're gainfully employed, when they're spending money. Stocks struggle, and only the strongest survive when the economy is doing poorly. So any interpretation of this news should conclude with this overall being a benefit to the stock market. If someone's trying to angle this news of how it's somehow bad for investors, I think they're just wrong. Now, we also had some breaking news as I released my episode just yesterday. The episode in part talked about the impacts that the port strike was having on the economy. When ports are shut down, there's a lot of waste that happens. There's billions of dollars that are lost every single day, and it has a potential to start inflationary pressures because there's an increase in demand and a decrease in supply. So overall, it's not a great thing for the economy, and the strikers were asking for a lot. Now, we got an update, breaking news yesterday, that this strike has been resolved. After receiving some government pressure, they agreed for a 62% pay bump. Now, with the resolution of the strike, I wanted to address some of the criticisms I received on the channel. If you want to see them, you can just go look at that video and look at the comments on it. Many people are in defense of the union and the strike, saying that they're fighting for the common worker, they're fighting to not be exploited and that type of thing. I understand those arguments, but I do not agree in this situation. And people saying that I'm anti-union, that I just don't like any union, is not the case. I think there are many situations where unions do need to put pressure on employers, but typically those aren't situations where they're holding the economy hostage and wreaking havoc on the US. In this case, straight from Bloomberg, they say the showdown on the East and Gulf Coasts has demonstrated the power of dock workers to play havoc with the US economy. To play havoc with the US economy. That's a direct quote. Draining billions of dollars each day and threatening supply chains for everything from fruit to automobiles. So right there, this is distinctly different than most strikes. When a normal group of employees strike, they typically hurt the company, the employer. That's the person that they're holding hostage, is their specific employer. They're typically not holding the US economy hostage. So this strike is unique, or it was unique in many ways from many other strikes. And that's why I look at it differently. So to be clear, any strike that holds the US hostage, that wreaks havoc on the US economy, that drains resources and billions of dollars from everyday people and increases prices, is something I'm going to criticize. It's not specific to these workers. I'm not saying they don't work hard, but it's the impact this strike in particular has. It's true that they are demanding a lot in pay increases, and they settled for a 60% increase in pay, but they also are demanding something that I think is even more damaging. They're demanding that there can be no automation at these ports. This quote right here is from the union leader himself as of this morning. Quote, "We will not accept the loss of work and our livelihood for the members due to automation. Our position is clear. The preservation of jobs and historical work functions is non-negotiable." He goes on to call for, quote, "absolute airtight language that there will be no automation or semi-automation." So in summary, this group is demanding that not only is their pay nearly doubled, but also the docks have to remain antiquated, outdated. No new technology can be used. No automation, not even semi-automation. Nothing that any technology can help with at all, because they need their jobs and they need double the pay. Does that sound reasonable? Is it good for the US to go decades with docks that are antiquated and outdated while China builds fully automated docks, while Los Angeles builds fully automated docks? But in this situation with these groups of employees, we can't. To me, that doesn't seem like the best idea. But there you have it so far. At least right now, they got close to the pay they wanted, and they're suspending their discussions about this until the beginning of next year. Now moving on, we get to this ongoing story here of the Mr. Beast Amazon reality show. Mr. Beast creates reality shows. That's what he does. That's his whole channel. It's just a reality show channel. And Amazon decided to give him a massive budget and give him creative control, the final edit on a reality show on Amazon. Mr. Beast views this as his kind of breakout moment from YouTube. He said on different podcasts that he has to get this right. If he doesn't get this right, if he screws it up on Amazon, he'll prove that YouTubers can't break out from YouTube, that they can't do anything in traditional media or streaming services. So he feels like there's a lot of pressure on his shoulders to make sure this goes well with Amazon. If in the other situation where Mr. Beast does really well, this may open up more avenues, more doors for YouTubers to do things on different streaming platforms. So he's really wanting to make this successful. Now the story goes through a lot of different details. It goes through Mr. Beast's challenges, the recent attempt to cancel him for XYZ reasons. But I think the most interesting part, at least from an Amazon shareholder perspective, is the clear illustration of what Amazon is trying to do here. Amazon spent over $100 million on this Mr. Beast show. They're willing to do anything to try to get to the point of where Netflix is. Anything to grow their streaming service into the globally dominant streaming service. He said, quote, "Yes, I also spent way more than $100 million. So Mr. Beast is saying that $100 million isn't like the budget. He's not saying it's a $100 million budget. He's saying that that's the minimum. He spent way more than that. Meanwhile, Amazon continues to spend more and more on diverse content. For example, just with sports content, they're increasing their budget from $1.7 billion to $13.6 billion. Netflix is dabbling in sports-related content. They have some different sports stuff that they might do, but they're not willing to put entire seasons of the NFL onto Netflix. It's not cost effective for them. Amazon seems far more willing to go into sports content than Netflix. We'll get to see how Beast Games does on Amazon when it's released next year, but it's become clear to me that Amazon is now the underrated company in streaming. It's not Max, it's not Paramount, it's not even Netflix anymore. I think most people are getting the message that Netflix is the runaway winner. Amazon is now the underrated company in streaming. They're launching ads on all of their streaming content, and they're increasing the amount of ads. That will generate a lot of free cash flow for the company over the upcoming year. And I still believe that they're going to have a high amount of engagement. Amazon has a great amount of diverse content, and like they're showing with this Mr. Beast content, they're willing to continue to invest aggressively into it. So as of right now, out of all these companies, Apple TV, Max, Disney, I believe Amazon has the most underrated streaming service. That's all for this episode. Hope you enjoyed. See you in the next one.